Okay, I hope we are all familiar, guys, about just candlesticks. I hope we are all familiar. This is just the basic candlestick and the most significant one. We don't care about the names. We don't care about the names. That what I once said. It doesn't matter what it is called, what it's called in your country or in your era or in that PDF that you read or in that video that you watch. The purpose, it is you to identify just the structure of the candle. It is for you to identify just the structure of the candle. But the most important ones, it is these ones, guys, the hammer and these doji candles, even these ones which are called hanging mans. So those are the most important one, guys, although the engulfing one are also important. But the reason these ones are so important, it is because they show you rejection. It is because they show you rejection through these tails here. They show you a rejection. So rejection is one of the important things in trading because it shows you where the deal was denied. It shows you where the deal was denied, or where they refused to take the deal or to buy or to sell that asset. So those are the significant ones, guys, those with wicks or tails. But even these ones with without tails or without wicks, they are also significant. But I just explained why these ones, it is because of rejection. So I hope you are all clear about this. So let us focus on the shape, not the names. So let us put it into chat. So remember, guys, the most important thing that we speak about here, even when it comes to you checking price on a high time frame, we focus on what? We focus on levels. I'm sorry about these things. Levels. Yeah, we focus on levels. That's what we focus on, levels. And more importantly, it is key levels. So once we spot key levels, that's where we pay attention to what is inside that key level. That's where we pay attention to patterns. Patterns, they are different. It is price action patterns, and then it is the candlestick patterns. So it's levels, and then inside those levels we focus on the price patterns, we focus on the candlestick pattern. Same thing applies even in trends. But however, when I speak about trends, there is no need for you to focus on a candlestick in this trade overall, but you only focus on a candlestick in a key level along the trend. You see, you just don't pay attention that if I see a doji, I am buying or I am selling. If I see a hammer, I am buying or I am selling. No, it doesn't work like that. It doesn't work like that. We focus on key levels. So let me just see an example for you here. So we have this example right here. Let me try to zoom it a bit. So we have this example right here. We have price touching or forming a new high, and then we know that this is a key level because we don't have any higher high or any high which is above this one. So we mark this as a key level, and we wait for the future to bring us surprises. So once we've marked this as a key level, we expect price to come back in this level again. So when price comes back to this level, that's when now we pay focus in what is inside this level, the patterns, candlestick, and even price action patterns. Remember also the most important principle, it is that we focus on how price approach that level. And then now I'm bringing you another one that we focus now on the details inside the level. We focus on the details inside the level. So once we have seen the details inside the level, then that's where we are going to see if we should respect that candlestick pattern or we should not. For an example, I'll make an example. There is no need for you to pay attention to a candlestick formed here or a candlestick pattern formed here. Why? Because it is not in a key level. You see, it has to be in an important level, or maybe somewhere around down here, because we also have something like a support. We have something like a support down there. So it has to be price in a key level, then we consider candlestick patterns. For an example, the reason about for us to observe candles in our trading, it is one thing, guys. We are here to find perfect entries. We are here to find perfect entries, and I'm just showing different ways on how we can enter the market. It's just different ways on how we can enter the market. So for you to get a perfect entry, it's either you consider what I spoke about in previous webinars, the issue of pattern breaks or the issue of patterns within a pattern. It's either you consider that one. However, a pattern break, I'm not crashing it, but I'm just giving you advantages and disadvantages. So a pattern break is safer. However, the safest things, they always give you some kind of a late confirmation, but it is not too late, but it's just after everything is clear. So it's the safest way. A pattern break is the safest way, whereby you'll only sell here. But then now with the candlesticks, that's where it gives you aggressiveness. That's where it gives you aggressiveness, because by you seeing this candlestick here, okay, let me just check here. Okay, they didn't give an example of it. So by you seeing this candlestick here in this key level, this doesn't guarantee you as a candlestick trader or as a price action trader to say, me, I am selling here. I am selling here. Even before I can see the sellers coming in, just because I respected a candlestick that tells me that something like a reversal is coming. Let me check. Someone is saying he can't hear me, but I can see my voice is just popping up very, very good. So let me just reply to him. So guys, it's an issue of understanding timing. In terms of the pattern break, it's not late. It's just good. It's safe. But in terms of the candlesticks, guys, it is earlier and riskier. So, but if you need to understand this, you need to make sure that if you enter with candlesticks, then your stop loss should be just above the high, as the law of candlestick says. It should be just above that high. So it means that now you as a trader, you are going to be selling here. What is that? You are going to be selling there in the red line here. So when you sell in that red line, it means that your stop loss is going to be in this dotted line there. In that dotted line. So now look at the difference. However, if you enter with the pattern break, your sell is there, and then your stop loss is also forced to be up there. What I was saying was that look at the difference in terms of your targets or your stop loss. So you can see that now the number of pips increases as you enter with a different system. The number of pips increases because you enter here, your stop loss is up there, and with the candlesticks, you enter here. After the close of that candlestick, you enter maybe somewhere here. You see the difference. It means that it is more riskier, but you risk less in terms of the number of pips. So what matters, guys, you have to hold this when you want to include candlesticks in your trading. Focus on the level where the candlestick is formed. Don't just focus on candlesticks that are everywhere. If there is no key level, it means that that candlestick pattern is significant, no matter how beautiful it looks. For an example, you can see this candlestick here. No matter how beautiful it looks or how accurate it looks, but because it is formed in the middle of nowhere, it means that that candlestick is useless. So here is another very, very important thing about candlestick. when it comes to breakouts, let me just check a market where we had a breakout. Oh, I'm sorry about that. Let's see. Let's see a market with a breakout. Okay, here it is. Here it is. Okay. Although I can't find what I'm looking for here, we have something opposite. We have something opposite. Okay, let me not just disturb this information that I want to give you. Let me just look for a good example. What about gold? Okay, let me just clear this chart. So, okay, let me just first drill the idea, then we are going to search for an example. Okay, we have this pay here. And we have this important support level down here. Right, this is the level. We have this important support level down here. And when we have a support level like this, we either going to see price going up, or we are going to see price going down. But I explained in the beginning of this of why did I sided with the sellers more than the buyers. Why did I anticipated that it is going to go down instead of going up? Just because it has been from a significant resistance level, so we're expecting it to go down to the support level. So once we have this, it's either we are expecting, okay, price to push up or price to push down. But then let's say you observe something like, let's say here in this wave, in this edge here, or in this high here, let's say you observe a candlestick like this. Yeah, it's a rough sketch, guys, you'll forgive me, or let me just forget about it. Let me draw a good one. Yeah, let's say we have a candlestick like this where the wick is longer on the upper side. We have a long wick on the upper side, which means that the sellers were rejected, or the price was rejected from here up there until it closed down here. Let's say it's a red candle, so it was rejected from there and it was pushed all the way down. It closed here. So because you have observed that candlestick pattern here, then it means that it is likely for the breakout to happen on this side that you thought of, this one. Why? Because here from this high there was so much rejection in such a way that we had a candle which had a long wick or a long tail on the upper side, meaning price was here and it was forced to close all the way down here. So it means that there was too much pressure pushing price down. So if there's too much pressure pushing the price down, that when we expect even high momentum candles, meaning big candles, you see, that's why we expect things like that. So that's an important aspect when it comes to breakouts. So let us check the market and then we'll make that example based on a good market. And even when it comes to ranging markets, guys, I once thought about it, but I will just remind you. Let's see what we can observe in this market here. Okay, it seems like there are no candlestick. The only candlestick we had was here on this support. And also this one, it has some kind of a long wick on the upper side, so it proved the rejection. So it was a good confirmation candle. Here we don't have anything. We don't have anything. And then here we have a fake breakout. So okay, guys, okay, let me just give you one important tip and then we are going to have questions and then we are going to end this. what we have to observe, guys, what we have to observe, it is the issue of trending markets and ranging markets. Those different markets, you approach them in a different manner. For an example, in trending markets, that's where we mostly observe these types of candlesticks, which we call engulfing. This one is a bearish one and that one is the bullish one, meaning it's the bulls engulfing the bears. Here it's the bears engulfing the bulls. So those are the kind of candlesticks that we observe mostly in ranging markets, in trending markets. Yet in ranging markets, it is those ones of doji, hammer and everything. But in trending markets, for an example, this trend here, why is it so in trending market? It is because trending markets, they always have one side which is stronger than the other. For an example here, it is sellers stronger than the buyers. So if it is sellers stronger than the buyers, then we expect that in these highs here, we find some things like engulfing patterns, whereby the sellers, they engulf the buyers. You see, when that impulsive move begin. So it is hard for you, although you can find those dodges, those hammers, but usually in most of the cases it is engulfing patterns. Why? Because we have one side stronger than the other. So for an example here, with this red candle which engulfs this green one here, we can see that the body, although it starts on the same level here, but we can see that on the downside it is very, very long. So it engulfed that previous one. So it was a confirmation for you to say, okay, now you are ready to go as a trader. Same thing applied here with this green one here, which end at the same level where this one opened, but on the downside we can see that the red one is longer than that one. It engulfed that one. So it's an engulfing pattern in a ranging market. So that's where, guys, you should observe these patterns. That's where you should pay attention to these patterns. In trending markets, observe the engulfing patterns. In ranging markets, or in where there is horizontal support or resistance, observe those dojis, the candles which has longer wicks or longer tails. So I hope that one is clear. So if anyone have a question, we can just tackle it. If anyone has a question, guys, before we close, we can just attend to it. That's it about candlesticks, guys. That's it about candlesticks.